In this video, traders, we're going to look at the benefits of thinking in terms of probabilities. Stay tuned. Hey traders and investors, a very warm welcome to you. If you are a veteran to the channel, appreciate your support and thank you for your subscription. If you're new here, consider subscribing for videos on trading, investing, psychology, discipline, strategies, all that good stuff, all here to make ourselves better traders. All right, with that being said, let's get rolling. So thinking in terms of probabilities when trading is a very, very powerful and useful thing. We've talked about this before. However, let's look at some reasons. How many have we got? Here's 7 reasons why thinking in terms of probabilities when you're trading is more powerful. Very quickly, what do we might think in terms of probabilities? We're basically saying to ourselves, hey, this strategy has a 60% chance of success, or it has an 80% chance of success, or has a 50% chance of success, but the risk reward ratio is X. So thinking of it logically as opposed to this trade must win, this trade must win, however you're framing it. So realizing that it's a probabilities game, like the casino model, the reverse casino model. The casino doesn't care what happens on each roulette spin, just knows with enough roulette spins, because of that zero he's got or a double zero he's got over time, or she's got over time, they will make money. That's what we're doing as traders. So let's look at this. Number 1, you're building an edge. You're understanding that, hey, if I use this filter, if I use this trigger, if I use this, this, and this, we're adding layers of edge to the trade. So you can start to say, hey, you've got a good probability of it working if I'm trading with a trend. Now, I want to also buy the first pullback. Now, I also want to wait for an oversold condition on a lower time frame. Examples, but the point is each of these has little edges, so you're stacking your layers of edge so that ultimately you've got a high probability of trade success. You don't know if it's going to work or not, but you're happy to pull the trigger because you've got all these things that you know, either you've studied or either you've examined yourself, either you've got experience of, know that help make this trade a better trade. Number 2, being more realistic. So you put less weight to a negative event. If you have a losing trade, you're like, hey, well, it's a probabilities game. Yeah, I may have a 70% chance of success here. That still means a 30% chance of a losing trade. This is just in that 30%. Even if it's a 90%, and by the way, it's very difficult to put these numbers on it for definite, but you can kind of broadly put a probability on it and say, hey, this is what I've had from experience, or this is what I'm guessing. But at least if you're thinking in terms of that, when you have a loser, you're not adding weight to it, saying, well, you know what, I'm never going to take those trades again. Even if it's the best trade ever, but it's got such a high hit rate, it's still going to be times when it doesn't work. So understanding that and accepting that, so not adding too much weight to the negative outcome of one individual trade. Number 3, being less emotional. So you're less concerned about losing trades. You understand that, hey, this is part of the game. If I take 100 trades, even if I've got a 80% probability, 20 of those trades are going to be losers. Could have 10 in a row, still be a great system. So you start to think more clearly and less in terms of how much weight, about putting more weight on one specific trade. Specifically, if it's a loser, a couple of losers, you're like, oh, is that the right thing? No, if the system and strategy is working, the conditions are right, all the things are lining up that you have in your trading plan, your strategy, but you're still losing trades, it's not the end of the world. If it starts to go out of what you expect, then you start to take some action, but it allows you to not be too concerned about those losers and allow for them in terms of risk capital as well. All right, number 4, being less attached. So less attached in terms of for the trade. You don't get married to the trade. You're not kind of thinking this trade's got to work, it's the best trade ever. When it comes down, you're going to pull the trigger on the stop loss. You're going to ditch it. You're going to move on to the next setup. It's just a vehicle to trade in. It's not something that you have to kind of always make money on. It's just something that you look at and go, hey, there's a probability of that being a good profitable trade. It's not worked. Cut it, move on, look to the next one. You're not attached to it. So thinking in terms of probabilities and instead of how this is the best trade ever allows you to not want to violate your stop loss, not want to revisit that just to get your money back, not to have that revenge mindset. All right, number 5, focusing on the process itself. So this is something we've talked about a lot on this channel. And if you're subscribed, you're going to know this. It's the process. So you're not kind of just wildly just taking trades. You're like, hey, I just need to focus on the process. I'm not focusing on the money. I'm focusing on making the right trade in the right trading strategy I've got for the right market conditions. If I do that, I'll pull the trigger, I'll pull the trigger, I'll pull the trigger. Work with the probabilities in my favor. Don't get over emotional about each individual trade. All right, number 6, where are we? Number 6, following your strategy. So the acceptance of losers is very, very similar to this one up here. But if you follow your strategy, you know that part of the strategy is going to create losers. That's just the way it is. There's no getting over it. It's just done and dusted. And if you think of it like that and say, you know what, I do not know if this is going to be a winner or a loser. It's a probability play only. It's a probability play only. And so that's how I'm going to look at it. And again, very similar, but it's just sticking to the strategy because you know you've got a positive edge. Number 7, keeping open-minded. So thinking in terms of probabilities and not getting completely kind of caught up in one specific trading strategy allows you to say market conditions have changed. Is there a strategy I can utilize or system I can utilize that works better in these conditions? And I'm thinking of it purely in terms of the probability of this, the risk reward of this, and just the numbers game. Yes, as I alluded to earlier, it's very difficult to say, well, that's got an 80% chance of success. You can't actually do that. You can look back and say, well, I've had success with this more often than not. I'm going to now extrapolate that forward and assume that in these market conditions that's going to continue, or whatever the case may be, if you've back tested, whatever. So you're going to have some idea, but the important thing is here, you're open-minded to say, you know what, I'm going to explore other things. This is a new market condition. This is a new way of trading. This is a new instrument, whatever it may be. Let me now be open-minded into the terms of probabilities and looking at terms of probabilities of things rather than actually the market or the price or whatever it may be. I'm just looking at in terms of how profitable my setup could be if I take 100 trades of this strategy. All right, guys. Very worthwhile thing to do is to consider trading or think of trading in terms of probabilities. 7 things here, which is 7 of the benefits of thinking probabilities. If you've got any others, stick them in the comment section below. Otherwise, thanks for your support if you're a subscriber. See you in the next one. Thumbs up if you like this kind of stuff. Much appreciated. Take care. Bye-bye.